All right, so we see the country is grappling with a dual financial challenge as it seeks debt forgiveness amid rising interest rates. The government's efforts to negotiate relief from international creditors as highlighting the urgent need for fiscal sustainability in the face of escalating borrowing costs. As interest rates climb, the strain on Nigeria's economy, we're seeing that intensify, complicating the efforts to foster growth and improve living conditions for its citizens. And we see the MPC, they're having to increase rates again. So let's bring in Ahmed Olaito Banu now, MD STL Asset Management, joining me right here in the studio. Great to have you.
How are you doing?
I'm doing okay, you know, at this point. You know, I bought fuel this morning, so I've been in a foul mood all morning, but I'm trying.
Everybody's in a foul mood, actually.
Yeah, every time I buy fuel, I get so
very
angry.
upset.
So upset. But let's look at it this time. You know, we're seeing another hike right now in interest rates, and definitely, you know, it has a way of finding its way back to higher prices. You know, we're trying to tame inflation at the expense, you know, of growth at this time. So, talk to me. How can we manage this? And we're hearing the government talking about debt forgiveness. You know, at this point, what are the prospects of actually getting most of this debt forgiven? You know, we saw the debt stock of the first quarter. It's a lot. What's the prospect of that actually happening?
Okay. Thank you very much, Ladi. So, it's quite interesting that we need to be very deliberate in our actions, and that's one of my key focus and key words in life. So, as we speak, 54% of our debts are domestic, while about 46% are foreign. And if we're talking about debt relief, I'm very sure we're referring to our external debt. And in order for us to, you know, it's been growing. Just looking at this current administration, sometime last year or early this year, there was about 2.2 billion loan borrowing from the World Bank. There are also indications that they might be going back to the World Bank very soon for another about 1.7 billion. And we're now sitting here talking about debt relief. In order for us to be able to achieve that, based on experience, we have two options. Based on the first option is we're looking at we doing it ourselves. And if we want to do that ourselves, we need to ensure that first we need to reassess our debt profile vis-a-vis our current revenue. How does that look like? You know, if we project that to the next couple of years, where do we see ourselves to be? We also need to look at making commitments towards what we would call reforms, more of structural reforms, I would say, because I would give it to the current CBN governor in terms of how he's been tackling from the monetary side. So we have to start looking at the structural, fiscal side of things. And if you start talking and moving forward, move further to that, we now start looking at how intentional are we in order for us to sort of block fiscal leakages. We also have to look at that. Then, if you talk about borrowing, transparency is key. You know, accountability, transparency, our records, how do we make information public, and how do we give everybody comfort to ensure that we're working towards that line in terms of getting everything intact for us to get that debt relief. Another option is for us to sort of tap into what I'll call the apologies, I lost my chain of thought.
No, that's fine, because at the end of the day, when you see that kind of money, you kind of find, when you're trying to understand the level of development and the level of debt, when you're trying to, marry that, you see that, development is not moving as fast as debt is growing. And I'm wondering if the debt or the monies are used well, then we might not have any issue when it comes to, we will have to be talking about debt forgiveness. If the money is used well, you actually use that money to make more money, so you're able to, sort that out. But let's look at this.
Takes you back to my first point of reassessment of our debt profile and our revenue. So if you link that up, there's obviously, if you are using the debt properly, definitely you're generating more revenues, and you won't be speaking about debt relief.
Right, because I would feel, really irresponsible if I rack up so much debt from, some of these loan apps. And those loan apps don't play. If you owe them and you don't pay, they will broadcast your name.
I won't call names.
all over the place.
I won't call names.
Let's look at this recent rate hike now. What impact will that have on, say, foreign portfolio investments?
So for me, February we started this interest rate hike. The monetary policy activities have been very active since then. We've been seeing a lot of surge into inflows into the country from FPIs. It's kind of interesting that sitting back and reanalyzing that decision, I would say it's a positive one. Yes, and I would say, even though analysts and a lot of analysts out there
and experts out there are saying, no, we expected a hold, not
or
another hike.
Decline. But the hike, if you think about it, was a good,
or a dovish hike.
It was a good chess play. Across developed worlds, there are cutting rate interest rates, and if you think about it, if you're an investor in America now, what will you be thinking about is how you can get higher returns, and you'll be looking at emerging markets, and one of the emerging market economies you would most likely consider is Nigeria. And considering that we're hiking our interest rates, which sort of...
So are we the next destination for the carry trade at this point?
I don't want to say 100%, but I would give it a very high possibility. And obviously we know that when FBI starts to come in, dollar comes into the economy, and we know how that stabilizes our exchange rate. So
right.
It was thinking about it truly again this morning. I actually said, okay, maybe it was a good one. Then another thing again I mentioned today is could it be holding it could actually be we being a bit premature. We've just seen 2 months of decline in inflation,
and we've seen what's happened with fuel prices in September,
and we just sort of want to now start holding rates. It would be good to sort of increase it and see how quickly that impact is going to sort of curb that PMS increases, and sort of maybe not necessarily further increasing, further seeing a decline in inflation, but putting us in a state where probably moderating it a bit, then watch over the next MPC meeting and seeing if we...
Yeah, we have the last one for the year coming up. But as an investor, I'm seeing rates going up where I am. Where do I pile in cash now? What sectors do I pile in cash that would favor high interest environment?
So from an investment perspective, I would still play with what we've been seeing happening in the market in the last couple of months since we started these interest rate hikes. Buy treasury bills, buy federal government bonds. I won't play towards corporate risk, and I'll tell you why I won't take corporate risk, because interest rate hikes means higher borrowing costs, and obviously finance expenses, finance expenses and all would also increase, which would also significantly impact profitability. Also would impact operating cash flows, if you think about it from that angle. And obviously, if operating cash flows are being impacted, then it means that there's a possibility that those companies might not probably be doing well, or might struggle after a while. And you've also mentioned something now, increases in fuel prices. And obviously, if fuel prices are increasing, we know how that is affecting consumer expenditure, which would obviously impact the revenue. So if you think about it from a business perspective, we might be thinking, okay, should we be investing, taking on corporate risk, or just stay where we are and continue to take benefit of the high interest rates that the government is actually paying us?
Right, and I've seen in other climes, when prices negatively impact, consumers, they look for who's profiting from that, and they slam them with a windfall tax. I don't know who's going to get a windfall tax right here.
Are you referring to banks?
I'm not mentioning your names. I'm just saying somebody needs to get a windfall tax if the consumers are having to go through pain when you're making a lot of profit. But thank you so much. Definitely a lot to consider, with this high interest environment. We'll see how it all plays out. Thank you so much, Ahmed Olaito Banu, MD, STL Asset Management Limited. It was great having your perspective.
Thank you very much, Lali.